Fed ends tightening cycle as gold and crypto eye liquidity shift. The Federal Reserve cut rates by 0.25% on October 29, 2025, and confirmed the end of quantitative tightening. The federal funds rate now targets between 3.75 and 4.0%. The balance sheet runoff will stop on December 1st, when all maturing Treasury and agency securities begin full reinvestment. The decision passed 10-2. Governor Stephen Moran voted for a larger 50 basis point cut, while Jeffrey Schmid preferred no cut. The split highlights growing division inside the committee as the economy cools, but inflation remains above target. Data leading into the meeting showed job growth slowing and unemployment edging higher. Inflation ticked up earlier this year and has not yet fallen to the Fed's goal. Chair Jerome Powell said the committee remains focused on stability, but acknowledged that financial conditions have loosened considerably. Markets reacted cautiously. Equities rose late in the session, led by financials and tech stocks. Treasury yields eased slightly across the curve, and the dollar index weakened modestly. Futures markets now price another 25 basis point cut in December, though Powell avoided confirming that expectation. This move marks the third major end to a tightening cycle in less than a decade. When the Fed halted balance sheet reductions in August 2019, gold climbed roughly 9% in 3 months and 15% in 6. Bitcoin surged 45% in the first quarter after that pivot. In March 2020, as the Fed launched new liquidity programs, gold jumped more than 20% in 6 months, while Bitcoin gained roughly 160%. Gold and digital assets tend to benefit when policy shifts from tightening to easing. Gold rallies as real yields fall, and investors seek protection from declining rates. Crypto typically outperforms in the early liquidity wave that follows. However, this cycle may differ. Inflation remains sticky, growth is uneven, and global central banks are not cutting in sync. As of late October, gold has started to firm while Bitcoin trades sideways near recent lows. Traders see this phase as a setup period rather than a breakout moment. Liquidity is rising again, but confidence in risk assets remains fragile after 2 years of volatility. If liquidity expansion continues through early 2026, both gold and crypto could strengthen, especially if real yields keep dropping. For now, the market tone is cautious optimism, mixed with fatigue from extended tightening. Disclaimer: this report is for informational purposes only and should not be taken as financial or investment advice.